I think that there is consensus that has been arrived at inaccurately. The consensus is that this quote-unquote war is only going to last days, maybe a week or two tops. But this is Trump just bullying Iran. And this is a blip in the timeline. Nobody really cares. It's not clear to me that that's right. In fact, I'll show you guys that I think that's really wrong.
In a quiet but highly unusual warning, the Sveriges Riksbank recently told citizens to keep at least 1,000 Swedish kroner in physical cash at home. The bank warned that payment systems could fail during a crisis, including war. And in a world increasingly dependent on digital finance, it said people should prepare for the possibility that access to money could suddenly disappear. Think about that for a moment. A modern Western central bank, in one of the most technologically advanced societies on Earth, is openly preparing its citizens for financial disruption caused by geopolitical conflict. That tells you something about the moment we're living in. Because while markets often treat global conflicts like temporary noise, some analysts believe we may be entering a far more dangerous phase of geopolitical and financial instability. And that's exactly the warning strike CEO and Bitcoin advocate Jack Mallers raises in his latest podcast. Mallers believes investors may be severely underestimating what's happening in the Middle East right now, arguing that the widely accepted narrative that the conflict between the United States and Iran will be short-lived may be dangerously wrong. Instead, he believes the situation could evolve into something far more prolonged and far more destabilizing for the global financial system. And if that happens, the consequences won't just be geopolitical. They could ripple through energy markets, inflation, global trade, stock markets, and even the future of the dollar-based financial system itself. So in this video, we're going to break down Mallers' argument, what the early signals in the oil market are telling us, why the global financial system might be more fragile than it appears, and what all of this could mean for stocks, inflation, and Bitcoin if the conflict drags on. Before we dive in, we urgently need your support. Please take a moment to like this video, subscribe to the channel, and turn on post notifications to support our efforts. Every action helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Late last night, when futures markets opened, oil went on a tear, okay? It broke through 100. It gapped all the way up to, I think, 130, 140 maybe. I don't know if it got that high, but it started to look like gas was going to be $5 a gallon. It was bad. It was bad. I mean, everyone was writing and estimating what inflation was going to be in prediction markets, and chances of over 3.5% inflation in 2026 broke 50% for a second. Markets started to really freak out. As I record to you now, I think the screenshot on the right is outdated. When I took the screenshot on the right for this episode, oil had fallen back below $100 a barrel. And I think oil now has an 8 in front of it. I think oil is in the 80s and has entirely erased the entire move late Sunday night. Okay, really quick on this. I just want to make the observation that, in my opinion, what Iran is doing is they're choosing inflation over nuclear weapons. What do I mean by that? Well, as we'll get into in the episode, I think that there is some very serious geopolitical games being played here between nation states. Very serious. I actually cannot believe the United States is engaging in this and is doing this. I am concerned, I would say, to just broadly state. I am a little concerned. The way that Iran is, quote unquote, fighting back is lesser with nuclear, right? That's the claim from the West, is that Iran has all these nuclear capabilities. They're out to blow up the whole world. They're fighting back with the oil price. Okay, they're effectively saying, in more or less words, which we'll get into detail later in the show, Iran's fight back is, we're going to close the Strait of Hormuz, which we've all talked about last episode. That's going to jack the oil price up. The oil price up is the price of energy. The price of energy causes inflation. Okay? You cannot tame and fight inflation if you don't have cheap access to energy, period. I don't care who you are, where you are. Okay? So the U.S. would get shocking amounts of inflation if these oil prices continue to trend higher. And Iran is effectively saying the U.S. can't afford this war. They can't afford it politically because they cannot afford another bout of record-breaking inflation. And they can't afford it fiscally because the U.S. is already about $40 trillion in debt, and the 10-year is still over 4%, and the bond market is not actually supportive of this war. We'll talk about it later, but for the first time in history, or at least in modern history, bond yields are going higher, not lower. Bonds are not the safe haven. The U.S. has no way to cheaply borrow to finance this. And so Iran's fight back is through the oil price. They're saying we can outlast what you can afford. We think that this is going to be days or weeks, and even if it's months, we can outlast it because Trump always chickens out. You guys can't afford it. Trump prides himself braggadociously about being the art of the deal guy. And Iran isn't buying it and is fighting back through the oil price. That's a key theme. So on the back of that, let's take a look at how volatile the underbelly of the U.S. actually is, because I would say it's very volatile. Things are looking very concerning. So the S&P 500 had its first 5% correction since November. The stock market doesn't look healthy. It doesn't look good. And it's kind of this perfect storm of ingredients. Because on one hand, you have this war, which is incredibly destabilizing. And the other thing about the war, guys, is, as I've said before, this fiat monetary system that we've built over time, us being the United States, it's a giant Ponzi scheme. And it's a giant Ponzi scheme because the people that largely own U.S. assets, like U.S. stocks, like U.S. treasuries, these are foreigners that we have been importing from. So the game is we print dollars, we export those dollars to these foreigners. The foreigners export in return things like chips, manufacturing materials, food, oil to the United States. So the United States is not a net producer. They're not productive. They run massive deficits. And we just export this printed currency and we import all this real stuff. So that creates a trade imbalance. That means that we get a bunch of stuff and the world gets a bunch of dollars. Now, what does the world do with all those dollars? They need to buy U.S. assets. It's like getting a bunch of U.S. store credits in return for oil, food, manufacturing goods. And so what do you buy with U.S. store credits? I might as well take a little bit of Google, Nvidia, Amazon. Yeah, I'll buy some T-bills. I'll buy some U.S. treasuries, right? And so if capital is returning home, if collateral needs to be sold to finance war, to finance higher energy prices, what gets sold off? What is the world collateralized by? Well, U.S. assets. And so stock market starts to see a lot of pressure during times like this because it's what the world owns as collateral in the system, which is really not good. That's bad. That's a Ponzi scheme. So the problem has always been Japan can't fall apart because if Japan falls apart, they sell U.S. treasuries in the U.S. stock market, which forces us to fall apart. So everyone has to stand tall or else no one stands tall. That's always been the Ponzi scheme. That's the domino effect, the deck of cards, the Jenga game where you pull one leg and the whole thing collapses. Now, on the other side, we have what we've been talking about, this extreme deflationary force where all of a sudden, AI is taking everyone's job. And the stock market is also facing some headwinds because all of the multiples on these businesses are being highly questioned. For example, all of the FANG businesses, the Mag 7, the big tech, these are not like insanely high margin stock buyback companies anymore. You used to be able to kind of, sort of, in my opinion, not really, justify these multiples because the margins were so high and they would take the free cash flow and buy back their stock. So it was like a cheat code. It was like there's going to be demand for the equity because the company that's making so much money is infinitely buying the equity because they have nothing else to do with the money. They can't invest it. Like, they can't employ planet Earth. There's not enough office space in the world for them to pour in tens of billions of dollars of net profit a year. So they're just going to buy back the equity in their business because it's better than holding cash or government debt. And so it was kind of like this hack. Again, it's just these are all functions of a broken monetary system. But now that's not how these businesses work anymore. They're not that profitable anymore because they're spending all of that cash flow on physical build out for AI infrastructure. And so not only is this going to really decrease their margins, it takes them from a capital light business to a capital heavy business. But the other thing is you're reducing the major buyer of the equity itself. People were comfortable buying the equity because they knew Google was going to be buying behind them. But if Google's not buying their own equity behind them, the question is who's buying? And if China's not buying and Russia's not buying and if Japan's not buying and Google's not buying, then who's buying? And you're starting to see a lot of weakness here.
What Mallers is pointing out here is something that markets historically struggle with: second-order consequences. At first, when the conflict began escalating, oil prices surged violently. Futures markets immediately priced in the worst-case scenario, the possibility that Iran could disrupt energy flows through the Strait of Hormuz, one of the most critical oil arteries in the world. Nearly 20% of global oil supply passes through that narrow corridor. So even the hint that shipping could be disrupted is enough to send energy markets into panic. And that's exactly what happened. Oil briefly spiked toward triple digits, inflation expectations jumped, and prediction markets started rapidly increasing the probability that inflation could surge again in 2026. But just as quickly, oil pulled back, and to many investors, that seemed like confirmation that the conflict would be contained. Mallers thinks that interpretation is far too optimistic, because what he's describing is a different kind of economic warfare. Instead of escalating directly with nuclear weapons or conventional military power, Iran's strategy may be much more subtle: weaponizing energy markets. Energy is the foundation of the entire modern economy. When oil prices surge, transportation costs rise, manufacturing becomes more expensive, food prices climb, and inflation spreads through the system. And that creates a massive political problem for governments, especially in the United States. After all, inflation was the defining economic issue of the early 2020s. A new energy shock could reignite the very problem policymakers have spent years trying to suppress. But there's another layer to Mallers' argument that's even more concerning. He believes the global financial system itself may be unusually vulnerable right now. Combine all of these forces: geopolitical tension, energy volatility, fragile debt markets, and shifting corporate economics, and you get what Mallers calls a very unstable underbelly beneath the global financial system. And if the conflict in the Middle East lasts longer than markets expect, those stresses could escalate very quickly, which brings us to another set of developments that Mallers believes the market may not be paying enough attention to.
So another really interesting thing we saw is the force majeure from Qatar Energy. So they declared a force majeure, which is basically we have to cease operations for something, like we have to violate a contract for something extraordinary that happened. Okay, so I have on this slide, Qatar Energy warns the Gulf is within days of stopping energy exports entirely. The Gulf states are reviewing hundreds of billions in promised U.S. investment commitments. So the Middle East is reviewing whether they actually want to commit to the AI build out in the U.S. And the SPR, the Strategic Petroleum Reserve, is at lows. It's drawn down from midterms. It was never refilled. So let me pause and explain this slide. So for one, Qatar Energy warns the Gulf that it's within days from stopping energy exports. We'll talk about this more throughout the episode, guys. I think that there is consensus that has been arrived at inaccurately. The consensus is that this quote unquote war is only going to last days, maybe a week or two tops. But this is Trump just bullying Iran. And this is a blip in the timeline. Nobody really cares. It's not clear to me that that's right. In fact, I'll show you guys that I think that's really wrong. But one hint is that Qatar Energy would warn the Gulf that it's going to stop energy exports entirely. Okay. Also, The US is in an AI race. They've declared that it is a national security threat if we don't win AI. And we now have kind of levered ourselves based on Middle Eastern capital. It's going to be really difficult for us to win this race without the support of the external investments to reindustrialize in the United States. Again, the United States has hollowed itself out over the last 40 years. The way I would describe the geopolitical chessboard right now is we are in the middle game, okay? The opponents so the United States and its opponents have played the opening, have entered the middle game, but people have committed to a closed position, to the bishop pair, right? Like there's chess moves have been played over 40 years. And, you know, the United States is now getting into like very dangerous territory where if they make a mistake, the end game is we're going to be at a disadvantage. It's going to be not so pleasant. And so the fact that the Gulf states are saying, well, hold on a second, we might not want to finance your AI build out, that's a direct threat to whether the United States can actually win the AI race. Because over the last 40 years, the United States has hollowed out its manufacturing base, its industrial. It can't easily produce things, physical things. Like if we need to build physical infrastructure, not only do we not have the skills to do that and the capacity to do that, but literally, who's going to be employed to do that? Remember, the United States is a white-collar dominant nation now. We've pushed everyone to the coast to do white-collar finance and tech jobs. We don't have hands craftsmanship. Like, no one's getting paid $250,000 a year to mine rare earths. I'd bet that people would, but there's not a market there. United States exported all of that to China. And so the fact that the AI race is now being threatened, it's a seriously noteworthy thing. And then the Strategic Petroleum Reserve. So I have this chart on here from Luke. So you guys can go to the slides on the internet now and click the source if you want to go sign up for Luke's newsletter. I highly recommend it. But this shows you the weekly U.S. Stocks of crude oil in the SPR. And you can see where Biden really started to use it in this post-COVID era. So Biden begins SPR drawdown in history to help contain oil prices post-COVID. And the level the SPR is at now, it was never refilled. And so we're at like 1980s level of SPR, which again is not good. Everyone is also leaving the Middle East. So check this. We have received info from our sources that Total Energies, ConocoPhillips, and Exxon are evacuating people from Qatar with evacuations planned from the UAE and the KSA. Guys, these companies, these energy producers, these oil majors, they would not leave if this was a 1 to 2 day thing, if this was a 1 to 2 week thing. Costco shipping suspends booking for Middle East routes amid conflict. Again, these are not things that would happen if the U.S. government is telling them, guys, we're ending this in a week. We're ending this in 2 weeks. This smells to me like this is a sustained war. This might take some time. The U.S. has entered something more serious than people realize. Now, this is just my opinion. This is a gut feeling combined with a bunch of evidence. But we go on, and this is from a Middle Eastern news outlet. I don't think that U.S. media would ever publish this. But check out the headline. Pentagon prepares for Israeli-U.S. war on Iran that could last until September. A conflict expected to last weeks is now stretching into months and threatening to dominate Donald Trump's presidency, according to Politico. Guys, this is not good. In fact, this would catch the markets entirely offside. I don't think that the stock market thinks that these oil prices are going to last till September, that this war is going to need to be financed until September. I don't think that the markets have truly appreciated all that's actually happening. It's not clear to me people know the game of geopolitical chess that the U.S., I can't believe the U.S. is playing this game. I'm a bit shocked. I'm always hopeful because I have Bitcoin and I don't need any government to take care of me anymore. But I'm shocked.
If Mallers is right, the signals emerging from the Middle East are not just about short-term military developments. They may be early warnings of a much larger geopolitical shift. One of the most concerning indicators is the possibility that energy exports from the Gulf region could be disrupted. Major producers like Qatar Energy have reportedly warned that operations could be halted under a force majeure scenario, essentially acknowledging that the situation could become too unstable to fulfill international energy contracts. That alone would have massive implications for global markets. But the ripple effects go even further. The United States is currently racing to dominate the next technological revolution, artificial intelligence. Yet much of the capital required to build massive AI infrastructure projects is expected to come from foreign investors, particularly sovereign wealth funds in the Gulf. If those countries begin reconsidering their commitments or redirect capital elsewhere, the U.S. could face a serious challenge in financing the enormous industrial build-out required for the AI era. At the same time, America's emergency oil buffer, the Strategic Petroleum Reserve, has been drawn down to levels not seen since the 1980s. That means the government has less room to stabilize energy prices if another oil shock hits. And then there are the actions of major corporations themselves. Reports suggest companies like ExxonMobil, ConocoPhillips, and Total Energies have already begun evacuating personnel from parts of the region. Global shipping companies are also suspending certain Middle East routes. Those are not the kinds of decisions corporations make if they believe a conflict will last a few days or even a few weeks. They make those decisions when they believe the situation could drag on for months. And that's the key point Mallers is making. Markets may be pricing in a brief geopolitical flare-up, but if the conflict stretches deeper into the year, potentially reshaping energy flows, capital markets, and global alliances, the financial consequences could be far larger than investors currently expect. Which brings us back to the bigger question. In a world where central banks are warning citizens to prepare for payment disruptions, where energy markets can move violently overnight, and where geopolitical tensions are escalating between major powers, what happens if the financial system built on cheap energy, cheap debt, and global cooperation suddenly starts to fracture? For Mallers, and for many in the Bitcoin community, the answer is simple. This kind of uncertainty is exactly why decentralized assets like Bitcoin exist in the first place. The rest of the world might not see the clear picture rest now, but if this crisis escalates as rapidly and deeply as Mallers is predicting, then everyone will soon be flocking into Bitcoin and other hard assets. The intersection of geopolitics, energy markets, and global finance may be the defining economic story of the coming decade, and the moves happening right now could shape the next phase of the market cycle. If you found this breakdown useful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss our next deep dive into the forces shaping the global economy and the future of crypto. Thanks for watching.